America deserves to hear the truth. Our national debt is too high.
36
$36 trillion. That's the debt, 36 trillion.
120% of GDP and rising debt service costs.
The International Monetary Fund has officially raised the red flag.
America has built many types of bombs, nuclear, hydrogen, even neutron, but now it has created the most dangerous one of all, a $36 trillion debt bomb. As Donald Trump would proudly say, it's made in America, but instead of making the country great, it's pushing it toward economic chaos. To understand the scale of this problem, consider this. $36 trillion is more than the combined GDPs of China, Japan, India, the UK, and Germany. The IMF has already raised alarms. Credit rating agencies have downgraded U.S. bonds, and global markets are bracing for what could be a third wave of economic turmoil similar to the Great Recession. America's national debt has surpassed 120% of its GDP, worse than even post-World War II levels. So how did the world's richest nation reach the brink of collapse without even fighting a war? America spends excessively every year, good times or bad. Key expenditures like defense, Medicare, Social Security, and debt interest take up 70% of the federal budget. The U.S. alone spends over $800 billion annually on defense, more than the next 10 countries combined, yet failed in places like Afghanistan. Add pandemic relief, infrastructure spending, and aid programs, and the government's outflow consistently exceeds its revenue. The U.S. has repeatedly slashed taxes, but the benefits have been skewed. The richest 20% received 65% of all tax cuts, while the poorest 20% got just 3%. This stems from the Reagan-era trickle-down economics idea. Cut taxes for the rich and hope the benefits reach the poor. But instead, income inequality has soared, as shown by the rising Gini coefficient. Government revenue is unable to keep up with ballooning spending. America spends nearly $1 trillion annually just on interest payments, more than the entire GDP of most countries. Since the government continues running deficits, it borrows more, issues bonds, and pays even higher interest. This leads to a vicious cycle: more borrowing, more interest, and widening deficits, a ticking time bomb that's been worsening for over 2 decades. Previously, countries like China and Japan held large amounts of U.S. bonds, but their holdings have decreased significantly. At the same time, yields, or interest rates on U.S. bonds are rising, suggesting falling global confidence in American debt. This becomes especially dangerous with proposals like Trump's One Big Beautiful Bill, which aims to make his 2017 tax cuts permanent while increasing military spending and slashing welfare programs. This bill could add $3.3 to $5.2 trillion more to the national debt, pushing debt-to-GDP ratios to as high as 129% by 2032. As a result, credit rating agencies are downgrading U.S. bonds. Investors demand higher returns, interest payments rise, and the U.S. risks entering a debt spiral, a self-destructive loop of borrowing to pay off previous borrowing. Economists like Ray Dalio have been warning of this situation for years, calling it an economic heart attack. The fear is that if demand for U.S. bonds falls, interest rates will surge, making debt even costlier. This could eventually lead to a full-scale economic collapse. If the U.S. falls into recession, India won't be spared. Here's how it would affect us. Stock market crash. Indian markets are heavily backed by foreign investors. A panic in the U.S. would cause them to pull out money from Indian markets and move it to safe U.S. bonds, triggering a sell-off in Indian stocks. We saw this exact sequence play out in 2011 during a U.S. credit downgrade, which led to a 10% market drop in India. Rupee instability. A crisis in the U.S. causes the dollar to fluctuate, which in turn affects the rupee. As foreign investors leave, the rupee weakens and inflation rises. Plus, India holds over $237 billion in U.S. government bonds. If these lose value, India's ability to defend its currency gets compromised. The most likely short-term solution may be quantitative easing, where the U.S. prints money to buy its own debt. But this can't go on forever. Unless the U.S. changes course, an economic collapse is inevitable. Maybe not today, maybe not in 2025, but eventually. And when it happens, the global economy, including India, will feel the shockwaves. Let's hope that history doesn't repeat itself, and that this debt bomb doesn't explode in our lifetime.